Strangely, the prospect for dividends in the UK are quite good. You'd expect with the economic environment being so terrible at the moment, that would not be the case. I personally believe the shares that I'm looking at, the companies that I see day in, day out, are in the best financial strength they have been. Their dividends are at least 2.5 times covered by their earnings, and that's the highest I've seen in my 20 years investing. So you will get your dividends, and you will see some dividend growth. Not maybe spectacular, we're talking sort of 6% dividend growth, but our fund is yielding 4.7 at the moment, so with 6% growth, that looks pretty good for UK income dividends. I think the appeal of equity income investing is it's a long-term investment. You get a check twice a year from the dividends from the fund, and over the long term the performance of the funds has been considerably better than the market as a whole, and that's because of those dividends. It provides a degree of robustness in difficult times and is attractive when people are looking for total returns, i.e. the addition of capital and income together. Well, the investment opportunities in 2012 are going to be quite mixed. We start with a very defensively positioned portfolio because things have been pretty terrible in Europe. But with that comes investment opportunity. Some companies' share prices have fallen quite substantially over this period, and those are the ones we need to look at for the next 2 years. We've owned some shares in tobacco, utility, and they've been fantastic performers for the fund. But going forward, will they really be the shares that will drive the fund over the next 2-3 years? I'm less certain on that. So we're having a look at some of these shares that have maybe suffered due to economic slowdown, seeing if there's an opportunity there. But always remembering they've got to be strong on their balance sheet, they've got to generate cash, and they've got to be good dividend payers. I think the threats in 2012 are going to be governments doing nothing, allowing the problems to persist. The electorate don't like it and the financial markets hate it. I think strong action, wrong or right, will give us the direction for which way to invest. That's what we need to see. It would be a little bit ridiculous to carry on as if nothing was happening out there and everything was brilliant. There is an absolute chasm that has developed between the company's welfare and the welfare of the governments. The companies have all the money and the governments don't have any. And when you're investing, you bear that in mind by the way that they interact with the government. Our overall view of the UK equity market is quite strong at the moment, and it comes from 2 reasons. Firstly, the valuations are very low against history, and very attractive because the companies are in quite good financial health. The other reason we're quite optimistic is that the UK market is not really to do with the UK economy, it's more to do with the global economy. The big companies are international companies. They do business right around the world. And as a consequence, their prospects are quite good at the moment. So when you think about investing in UK equity, it's not just UK economics you're dealing with more global economics. And as a consequence, we've got very low valuations, and the overall world economy is in a much better shape than just the UK alone. So the two combined, good environment.